self-managed super funds. It's something that's been around for a while now, but a lot of people still don't know that they can actually use a self-managed super fund to create more wealth and actually invest in more property. They don't really understand the tax benefits that are associated with it later. But what is a self-managed super fund? So basically, effectively, like most people when they're working, they will have a super fund. And back in the day, your employer generally picked your super fund through an industry body. But now, I think it was 5 years ago, or how many years ago did it change where you get to pick your own super fund? I don't know exactly. We could probably find that out. But there was a few years ago where that changed, and you can effectively have your own choice in your super fund. But on top of that, if you have a certain level of money in your super fund, and we would usually say anywhere 100 now, we're saying 100 plus, you can set up your own managed super fund, right? And you can then invest that money into other assets, property, shares, or other forms of investments. How you do that and how you structure it needs to be done correctly. That's why we've got the team here, and there's another team in the behind the scenes. But I wanted to touch on today is how you can actually use super, setting up your own super fund that you can borrow, and what are the tax benefits. So Brendan, can you explain a little bit to everyone around how you borrow in a super fund?
Absolutely. Look, there are very specific structures. It's a specialised area, and those structures need to be done in conjunction with an accountant, and we will talk you through all that with an initial meeting. And once you have that structure in place, it's specifically called a bare trust, which allows you to buy a residential or commercial property in that trust in your super fund, and that trust is able to borrow money. So it works now quite similarly to the type of language you'll hear in residential lending, even though a lot has changed in this space as well. And a little bit of quick history, a lot of it changed. There was major banks were involved, so all of the big four and a few others were involved in self-managed super fund lending. And then most of those after the Finance Royal Commission from 2017 to 2019. Once that was handed down in 2019, they started to pull back from that space. I guess the increased scrutiny, regulatory pressure that went with it. So all the people who had a self-managed super fund loaned, and there's a lot of people out there who do, which would now be considered a grandfathered product because that bank's no longer offering that product, might find themselves on 9 or 10% rate.
Yeah.
So instead it's moved into an era of non-bank lenders, and there's a number of them, and that's made actually some really exciting things happen in this space because it went from very strict LVR positions, liquidity ratios, meaning you had to have a certain amount of cash left in your fund as a percentage of the loan you were taking, maybe a net asset position in that fund.
Yeah.
With a number of lenders now, they're wiped. So it actually, you only need to show a minimum of 3 months ability to make the repayments on the loan that you're making, and then have the standard deposit as you would in a residential space. So an 80% LVR can get you rates as low as, well, in the residential space, mid-sevens.
So basically, when you've got enough money in your super, like when you're talking like property, if you've got 25% of that value of that asset and that amount of money is sitting in your super, then you can effectively use your super money once you've set it up correctly to be forming part of the deposit and the stamp, and the costs associated.
And cover the fees, exactly.
And then what actually happens if you are paying, or your employer is paying your, what is it now, 10%? 11% contribution towards, that money goes into the super fund that you set up and the rent goes in, right?
Exactly right.
To pay for the loan. So even servicing, what I've found is when you guys have run capacity, people can often service a loan in their super fund where maybe they've sort of capped their servicing outside of their, in their traditional income.
Exactly. And not only that, it doesn't actually impact your individual servicing. So if you're 11 or 11.5% and that's increasing and will continue to do so, if your statutory contribution combined with the rent that property is receiving is enough to service the loan, then you're not individually using your income for the servicing. There are options where if you need to, you can co-contribute, and then of course your individual position is taken into account. But in most cases, once you have that 25% deposit, as you mentioned, it can be done with less deposit. There is space to go up to 90%, but that would be a really good aim to have 25% of the purchase price as a deposit in your super fund. Then you're able to get not only really competitive rates, not too far above what you'd be paying in the residential space, but it services outright within its own. It's within its own space. So your contributions going from your employer or from yourself if you're self-employed rental income, and that loan really is set and forget, and your super fund's going to benefit from the growth that you get from that property over time.
So what are the tax benefits of having a property in your super fund versus having it in your own name?
I'll definitely come to that. With the self-managed super funds, it's important to note that you can actually do a self-managed super fund with your brother, your neighbour. You can do a self-managed super fund with
multiple contributors.
Yes, which can increase the asset, your asset base in there, so that you can. But it is also important to note that once you own that property, you can't actually borrow to renovate the property. So
I was going to come to that about what you can and can't do.
So there are some rules.
So most cases, though, we're seeing, like in my experience, I'm seeing like couples doing a self-managed super fund together,
predominantly, or siblings,
or generally that is where
because you've got to have some sort of exit plan. And we've got clients who are doing it with their children, so their children are in their 20s, the clients are in their 50s or 60s,
and it might only be part of the parents' fund.
That's right, and so of course every year your accountant has to work out who owns what percentage depending on what's been put in. So there is quite a large accounting cost.
Yeah.
The more participants you get in those,
and that's so that's one of the cons. There is more costs associated with the setup, and the ongoing. But that's why you need to have 100 minimum. You're saying,
and there is actually a space now, Hub 24, this really innovative managed fund space that have sort of entered the market sort of 5 or 6 years ago, and they just go from strength to strength with the products that they come up with. And they have a product now which is a self-managed super fund option for young professionals who've only got sort of anywhere under 150,000, and you can set up a self-managed super fund with Hub, much lower fees. Fees are minimal, but it just means that you don't have any capital gains. When you want to roll your money out, you are in a self-managed super fund. So when you've got enough of a balance in that portfolio to purchase a property, nothing has changed. You've already got a self-managed super fund set up, and then you convert over to the traditional accounting method of having a statement of advice set up, the purpose for your investment. There's so many rules with self-managed super funds.
So why would what are the tax benefits when you buy in your super fund? It's more around when you retire.
It is. You don't get the capital gains tax benefit, but you're always in that tax effective environment at 15%. So if you're in the highest marginal tax bracket, buying in your self-managed super fund is a fantastic way to negate or to minimise a lot of your tax obligations that you would have outside a super fund. When you go to sell that property, you don't get the capital gains benefit, but if you do your retirement planning properly, and we do what we talked about, that transition to retirement, we can often come up with ideas, co-contribution strategies. There's all sorts of different strategies that you can use at sale to try and...
I heard when you hit the age of 65, which is the retirement age, and you own the property in your super fund, that you don't have to pay any, you can draw the money out, any of the rental income. If you sell the property... Once
you flick to pension phase.
So that's the biggest benefit.
100%. Once it's in super...
That's the biggest.
Phase.
But you can get that benefit outside of super as well, because if you plan it properly, you can sell properties prior to retirement age. You're allowed to contribute so much money per year into super at that.
But let's say you've been building a portfolio of property for a while and you've made gains over $1 million.
Yes.
Having again, it's plan, knowing where you're going to land. I know for a lot of clients coming through now at a younger age, they want to have 2-3 properties if they can. Yeah. If you're someone like that, understanding also having that super fund and knowing when to roll properties into it, because I know that if you've made $1 million profit, having no capital gains tax or living off that income, which if you're building phase, that's a good thing. But I think being able to borrow, I think I've found some people have hit that limit of borrowing power.
Yes.
And but they've got plenty of super.
Absolutely.
But they want to keep building on their wealth. So it's a good opportunity to talk to people about that. It may not be for everyone, it may not be for you, but it's definitely something that I think we're always talking to clients about. You guys are always talking to clients about.
There's some great ways to get into the market that way. Like honestly, siblings are a really great example. I've got some great examples of siblings who've bought properties together in their super fund, and because they couldn't have done it on their own, and then they get to capitalize on that growth. And you're in this. It's just there are some really
So
great
can you live in the
strategies.
property in a super fund? No,
you can't.
What are the cans and can'ts? So you can't live in it, you can't renovate it.
No.
Yeah.
And I don't even think
you can buy off the plan.
So you can maintain it. So any money that's in the fund, because we've even got super fund lenders now who have offset accounts. So you can actually offset the loan. So it's been a contentious area under legislation, under the Superannuation Act. However, there are lenders offering it, but there are very strict rules around how you use the money in the offset. But they're the same as the rest of the money in your self-managed super fund. So the house can be maintained.
Can you borrow
against? But it can't be renovated.
The house?
No, you can't borrow against it. So you can't redraw on a loan or borrow against it for another purchase. However, once your self-managed super fund hits a certain threshold, you can have a separate bear trust and buy again. We have
This is where adding a
many
sibling
clients with
can help you
multiple
buy another
properties.
property or another family or your adult children.
Exactly. And it might be a client with 2 or 3 properties in their self-managed super fund and multiple bear trusts, or have clients who don't have the borrowing capacity to buy an investment property in their own names. They have their own occupied home. They'd like to have one in their estate which they can leave to their kids one day. So they're able to buy through a self-managed super fund. And ultimately, once they hit pension phase and that house becomes theirs, it's part of their estate.
A lot of government workers, police officers, any health work, like they get extra super. So I'm finding people that are in their late 30s, early 40s have all got significant amounts of super in those industries.
That's right.
That aren't really even aware of this because it's not something that they think about. They think super retire.
I know.
Yes.
It's that future person again. And it's like, it's your money.
But it's like wow, like you actually could be building wealth, because if you wait till you retire, that money's not that worth that much.
And if they're in a profession where they actually need a space, whether it's a retail space or an office space, then that is the one exception to the rule with the retail. I mean, if it's a residential property, you can't put friends or family in there. It has to be very much arm's length. That's very strict. However, with a commercial property, of course,
your business can rent
your business can rent it back off yourself. And that is something which we have a very large number of clients who do, whether they be the lawyer who's renting back the space for their use as a premises, or a building designer, and a whole myriad of everyone in between.
100%. So if you are self-employed and you need a retail or industrial space, looking at the super fund to buy the asset will help you, because you're effectively paying the rent to yourself rather than someone else. So that's, I'm very pro rent vesting, and that's a whole nother conversation. But that is an exception to the rent vesting in another whole way.
Yes.
Like I'm always thinking like, how can you use your money to get more wealthy, and what are the smarter ways to do it? Yeah. And I think, look, if anyone's got questions about self-managed super funds, they can reach out and ask. But if you do have anywhere above 100,000 in super or a lot more, it's definitely worth opening up that conversation. Thanks, guys.
Thanks, Anna.